Hey guys, welcome to another episode on Groww with me, Shashank Udupa. And today we're going to talk about something that a lot of people want us to talk about, and that is index fund versus ETF. Now, a lot of people in the industry or in the market are very intrigued by this index funds and ETF. They want to know what it is. And a lot of people have called it passive investing, passive funds. And we want to know what it is basically, right? So in this episode, we're going to talk about what index funds are, what ETFs are, what are the difference between the two. And more importantly, why are people doing this? Why are people investing in index fund, right? So that we'll look at in the next segment. Now, let's understand why people are investing in passive funds or maybe like ETF and index funds. Why are we investing here? Now, the reason is very simple. For most of the investors, passive funds like ETFs or index funds offer this level of simple returns, okay, simplicity, and also give you good returns that maybe an index is doing as well, okay, or which is matching the index returns. Now, I'll tell you what, for most people in the stock market, it is very difficult to do research about the stock market. It is very difficult to understand how the stock market works. They have to educate themselves first, and they have to keep doing research on particular stocks. And after 3 months, when the results comes out, they have to do research again about each and every stock, right? So what people usually do is they're like, you know what, boss, I don't like all this. I don't want to do my research. I just want simple returns. I want returns coming without any knowledge. I don't want to put so much effort into thinking. So let me get simplistic knowledge, right? When you want simplistic returns like this, the people invest in something known as an index fund or an ETF. Now, why is this growing a lot in India, or why is so much attention coming for this in India? Because if you invest in an index fund or an ETF fund, it actually gives you 3 types of benefits. And the 3 benefits are basically you participate in the equity market of a growing Indian economy, because Indian economy is growing really well right now. So you get the chance to participate in the equity market without doing too much research on it. Second thing, it is not very expensive to invest in index funds or ETF because they are not actively managed mutual funds. They are passively managed mutual funds. And if it's passively managed mutual funds, then it's very cheap, right? Because there's something known as expense ratio that a fund or AMC house charges. So if you look at passively managed funds, that expense ratio is very low, which gives you a very good benefit. The third thing, there is no fund manager risk. Now, let me explain this properly, right? If there is an active fund, the main goal of an active fund is to beat the market, somehow beat. If the market is giving 10%, I want to get 12% returns. So the fund manager who's running it has to be really good. And then he'll have a team of analysts and researchers below him who will come and tell him this stock is good, you should buy this, you should sell that. And he will take the final call so that you can get good returns at the end of the year, right? But if it is an index fund or an ETF, the fund manager is not very important here, right? Because it is a passive fund, so he's not actively managing it. He does not have people under him, right? Because he's just replicating the Sensex index or the Nifty index. So that is what is happening. So when that happens, the cost is not very high. So if the cost is not very high and it is very low, then you don't have to pay so much money to them as well. So the expense ratio automatically goes down. So that if expense ratio goes down, you're maximizing your returns on a yearly basis. So that is what it happens, right? That is what happens in an index fund. In India, okay, we have seen that active funds have been there from a long period of time. Like in India, active funds have been there since the start when mutual funds have come into the picture. Now, in the last 5 years, we have seen a lot of passive funds coming. Passive funds with low expense ratio. Now, in USA, this is slightly opposite, because in USA, passive funds account for more than 50% of people's AUM, which is assets under management. But in India, passive funds AUM is only 10%, little less than 10%. So, in USA, a lot of people invest in index funds, right? Because they don't want that tension of understanding how it works. They just want to invest and see whether it grows up or not. That's it. Now, let's look at some data, okay? Because you might be like, okay, you know what? You're talking about ETFs, you're talking about index funds, you're talking about passive funds, but are they better than active funds? Because active funds want to beat the benchmark index, right? And we are only looking at index funds and how index funds work from that perspective. Now, recently, Economic Times did a study. They took the performance of the last 6 years from 2015 to 2020-21. Okay, they took 5 to 6 years data and they tried to compare the large cap category with the benchmark index of large cap. They took mid cap, they took the entire mid cap category and compared it to the mid cap benchmark index. Then they took small cap and compared it to the Nifty small cap 100 TRI also. So they compared all 3, and guess what they observed, right? They observed that active large cap funds have underperformed 5 out of 6 years to the benchmark index. Mid cap funds have underperformed 4 out of 6 years in the mid cap index. And finally, small caps have outperformed, right, the index for 5 out of 6 years. Now, in the last 6 calendar years, we have seen that passive funds in the mid cap and the large cap category have actually outperformed active funds as well, right? However, but if you look at active funds in the small cap category, they have outperformed the index almost all the time, right? Now, in FY21, we looked at most of the equity mutual fund schemes have underperformed the benchmark index. That means all these active funds that are taking high expense ratios and vowing to actually beat the entire benchmark index are not able to beat the benchmark index for a very long time. Now, for instance, 93% of the large cap funds underperform the benchmark index, 93% of them, and 82% of them, 82% of the mid cap funds have also not performed well and not beat the benchmark. Okay, now we have understood what index funds are, we've understood what passive funds are. Now let's understand what they are basically, right? Now we have two things to look at over here. One is an index fund and one is an ETF fund. Now what is the difference between the two? Index fund is basically a mutual fund, a typical mutual fund that actually replicates a particular market index. So it can either replicate a Sensex index or a Nifty index or maybe any sector index as well, like Bank Nifty. Now, there is no original strategy over here. There is no active management that a fund manager is doing. Everything is automatic. Everything is passive. That is why it has a low cost structure, and it's typically an it's than any active mutual fund. It is very low in cost, right? Because if you expense ratio, if you compare from a passive fund with respect to an active fund, you'll always see that a passive fund has low expense ratio. Now, if you look at exchange traded funds or ETFs, they're very similar to an index fund wherein they also track a particular market index. However, in ETFs, they are more used to, like, they're more looked at as an equity rather than a mutual fund. They're listed on the stock market as individual stocks, so you can actually buy them from the stock market and you can buy and sell them anytime during a trading day. The prices keep going up and down constantly. Now, let me show you one table which shows the basic difference between an index fund and an ETF fund. Now, look at this. There's active funds, there's index funds and ETFs. If you look at fund manager risk in active fund, yes, there is fund manager risk. Why? Because the fund manager is the person who's running your active mutual fund. But in index fund, there's no risk of fund manager. ETF also does not care about the fund manager so much. If you look at the investing strategy, active mutual funds obviously have an active strategy, whereas the remaining two are passive funds who have a passive investing strategy. If you look at their expense ratio, obviously active funds have a higher expense ratio, so you'll see around 1 to 2%, whereas index funds are passive run funds and ETFs are passively run funds, so their expense ratio is barely anything. It's 0.25 to 0.5% and 0.05 to 0.1%. Now, if you look at from a demat perspective, you don't need a demat account for active mutual funds and index funds because it's a mutual fund investment. But if you look at ETFs, which are traded on the exchange, then you definitely need a demat account. Now, if you have brokerage, again, mutual funds and active funds and index funds don't need brokerage, don't have brokerage, whereas ETFs definitely have brokerage. Why? Because they're traded on the exchange. Now, listing on the exchange, is it compulsory for mutual fund to list on an exchange? Not that compulsory, right? But is it compulsory for an exchange traded fund to list on an exchange? Obviously, it is compulsory. Now, if you look at liquidity, right? Liquidity is basically how liquid is the market. Can you remove your money quickly? Can you invest quickly? Can you easily buy and sell? Now, both active mutual funds and index funds are highly liquid in India. A lot of transactions keep happening. But if you look at ETFs, not that liquid in India at the moment. It can be much better, but not that at the moment right now. Now, how is the pricing determined? Now, if you look at the NAV, okay, which is net asset value. Now, if you have to look at the pricing of a mutual fund, you have to look at the end of the day NAV and then buy those mutual fund units for both, right? Index fund and for the mutual fund. But if you look at exchange traded funds, you can actually go buy it like a stock itself on the stock market. So there is real time price on the exchange that is going on. Now, if you look at redemption is basically what's selling it, right? Number of units will usually fall during redemption on both sides. But over here, it is basically like a stock where the seller and buyer gets matched and it's like an equity stock, as simple as that. Now, those are the differences. Now, there's one more very important thing to look at when it comes to index funds or ETFs. Okay, and both have this in common, and that is something known as tracking error. Right now, you'll be like, Shashank, what is tracking error? I've never heard of this in the past, right? Now, tracking error, now look at this. ETFs and index funds have to match the index. So if the index is going up by 20%, you should also be at 20%. But that doesn't happen usually. And that is what is called tracking error. So usually what happens is the difference between how much the benchmark index is going and how much the ETF or index fund is trading, there's a slight difference, not a very big difference. It will be point something difference, right? And that is known as a tracking error. So, but it is loss of percentage if you're not tracking it properly, or if the fund house or the fund manager is not tracking it properly. Now, you as an individual and as an investor should pick the fund that has the most less tracking error or minimum tracking error should be there. Tracking error happens why? This might be due to the delay in the holding adjustments between the index tracking and the main index fund and the tracking index. So if there's something that gets changed in the Nifty or this gets changed in the Sensex, then the ETF or in the index fund also has to change that in their own fund, right? So when they have to change that in their own fund, it creates a slight issue at that point. So now basically guys, you know the entire features of index funds and ETFs, you know what tracking error is, you know how expense ratio works, you know what's the difference between index and ETFs, and you know why people are investing so much in passive income funds more than active income funds. And this is a constant debate that's happening in the entire industry, that is active funds so good even though they're taking so much expense ratio, but are they better than passive funds, or should I not think too much and just invest in a passive funds and not worry about anything else? So this is the main concept that's happening. This was the video on index and ETFs. I hope you guys enjoyed this. I hope you guys liked this. And if you have any choice, I want to know what you guys prefer as well. So put in the comments below whether you prefer investing in an index fund or in an ETF, or do you prefer investing in an active mutual fund over and above an index fund? So I want to know your take on this. So put in the comment below. I will not tell my take, but I want to know your take as well. Any stocks or mutual funds that are recommended in this video are not a recommendation to buy or sell, or anything that's mentioned in this video is not a recommendation to buy or sell. This is only for educational purpose and nothing else. But again, if you like this video, do share this, subscribe, comment below, like it. I will love it if you guys like the video as well. And obviously, I will see you soon in another video. This is me, Shashank Gudapa, signing off.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.